Got some good questions. We had a question I'm looking at here in the chat. It says, what is the difference between CPI-U and CPI-W? There is an answer to this question. Karl, can you research that while I'm doing this? I will continue here. Can you guys all see the screen? Am I in the right spot here, Karl? Am I sharing correctly?
Let me check here. Look to be yes.
All right. So we will resume, and then our research team will be working on these questions as we proceed here. So let's switch gears to talk about net worth for a minute. And this is a Fed analysis that they do every quarter. Usually comes out close to the start of or for the end of the next quarter, so you have to wait about 3 months for it. The figures I'm going to share with you are adjusted for inflation. So these are real in current quarter dollars, meaning the dollar value of the latest quarter on average. So we could take a look. So right now, the bottom 50% group has a net worth per household of, on average, of 55,000 or so, 55,100. Up from the prior quarter, it's 45% higher than pre-pandemic. And a lot of that for this group is driven mostly by housing. Not stocks for this group. They don't own a large percentage of stock. It's almost all housing. So it's not like they can just spend all this money. Although you can extract equity from your home if you choose to do that, or if you feel richer, you can spend, maybe encouraged to spend a little bit more. But quite a big jump from pandemic. Why did it change? It's all housing, as I mentioned. So the net worth of this group was about 2.4 trillion. And I'll show you in a minute how that's a tiny fraction of U.S. net worth, which is more like 150 trillion. So this group has a very small fraction of the net worth of the United States. But 2.4 trillion, about a trillion added from housing. So another dose in consumer durables. So this would be like refrigerators, dryers, things that last a long time. Most of the other categories, fairly minor. Mortgages being one where there are more dollars in mortgages. So that was a reduction in net worth, meaning more mortgage debt. But surprisingly, consumer debt, credit cards, was really unchanged from before the pandemic. So even though you're hearing in the news that people are adding more and more credit card debt, that hasn't really, at least adjusted for inflation, hasn't really started to weigh on the net worth calculation. We'll see if it does in the upcoming months and years, but right now it's really all a housing story. And the durables, this is where people are putting their money into goods, or have put their money. And here they are now at $3.6 trillion, that group. This is for the 50th to 90th percentile group. They're getting into the middle class and upper middle class here. Up also about 9% versus pre-pandemic, plus 3% versus the prior quarter, down from the peak. And the first quarter of 2022 was the peak around the time that the stock market peaked. The stocks are a much bigger chunk of the money that this group owns. Not just housing. I didn't see the same breakdown like the last group, but you would see if we did this again for the 50th to 90th group, you'd see a lot more in this other assets group, which would have been financial assets like stocks. This number would be a big part of that increase. So still not 10% increase, still pretty significant versus pre-pandemic. Now this table takes a little bit to digest, and I've explained it in lingo down here, but let's do a couple of examples, then it'll make sense. So here are the groups across the top. Here's how much net worth they had in the fourth quarter of 2019. So the top 1% had 39.76 trillion. And in the second quarter of 2023, 45.78, again, adjusted for inflation. So we're talking apples to apples dollars here. That's an increase of 6 trillion. So 45 versus 39. That's a 15% increase. And that 6 trillion divided by the 16 trillion increase across all the groups is where you get the 37%, meaning that the top 1% got 6 trillion of the 16 trillion increase in net worth during that time. That's almost it's a little over a third of the gain. Does that make sense? So when you add these up, 39, 50, 37, 2, you get 129. Same idea here. You get to 145. The difference is 16. 12% increase in net worth overall. And each group, you can see the share of the gain that they got. So the 6 divided by the 16, that's the 37. The 4.68 divided by the 16, that's the 29. et cetera, as we go across. So what you see here, if you look at the bottom 50%, they had a 49% increase in their net worth, 1.19 over 2.45, 49% increase, but only got 7% of the gain. So this 1.19 divided by 16 is only 7%. So yay on the increase, boo on the share. All right, does that make sense? You guys with me? I see some nodding heads on here. Takes a second to absorb all these numbers, but now let's go to the share numbers down here. This is saying how much of the net worth do they have. So this is, let's use the Q4 2020. I'm sorry, this should say Q2 2023. I always do that. So this is Q2, that's the latest data. But the 45.78 out of 145 is where you get the 31%. So 45.78 divided by 145.97 is the 31.4. Same idea if you were doing that with the Q4 of 19, 39.76 divided by 129.83 is that 30 point, gives you the 30.6 share. So top 1% has about 30% share of the wealth. That is, they're punching way over their weight. They don't, in a perfectly equal world, they would have 1% of the wealth. They don't, they got 30% of it. The 90th to 99th group, so about that 9% of the population, 9% of the households has 38%, has about 38%. And you can see 50th to 90th, 29, bottom 50% only has 2.5% of the wealth of this group. So they are bottom 50% punches way below their weight. And the changing share is the difference in these numbers. So the top 1% saw their share increase. The middle two groups saw their share decline. And the bottom 50% actually saw their share go up from 1.9 to 2.5, although they captured only 7% of the wealth gain during that time. So that's a big mouthful on a lot of numbers. Is that, you guys with me? Can you see the math? So that's how this table works. And then it's in, what I just said is in language down here. So let me just read one of them as an example. Top 1%, real net worth increased by 6 trillion or 15%. There's the 6 on the left side there. And there's the 15. Increase is 37% of the 16.14 total. 16.14 is over there on the right-hand side. 6 divided by 16 is that 37%. And then share of total net worth increased 0.7 to 31.4. That's down here in the lower left corner. Same with the rest of the groups. So I can't tell you, we can go on a wild tangent with inequality. Income inequality, we don't have it covered in here. Income inequality is nothing compared to wealth inequality. The top 1% after taxes get like 12 or 14% of the income, but they've got 31% of the wealth. So 12% of the income, 15% of the income, maybe, but 31% of the wealth. Hence the idea of a wealth tax or taxing that group, even further, taxing at much higher marginal rates, taxing capital gains a little differently to pick up, because almost all the capital gains benefit of a lower capital gains rate, that 20% preferential rate goes to that top 1% group. All right.
This is very ugly. This is very ugly and not sustainable.
I mean, there's a theory that part of why Trump was successful and some of the anger that simmers in the country is an understanding that things aren't fair. And they look to a strong man to straighten things out because the system isn't working. And, that's what democracy's up against, not just here, but in other countries. That kind of inequality, I think you got a point, Sonny, is that it puts enormous pressure on the democracy when the inequality is severe. It is not helping. One good piece of news we're going to share here in a minute is that inequality, at least from an income perspective, is getting a little bit better in the last year, but that doesn't reverse, this giant problem, which is the bottom 50% has a small share of the wealth, has 2.5% of the net worth, and only captured 7% of the gains since the end of 2019, in what has been a very prosperous time, other than obviously that window of time when we had the crisis. But I mean, if you just look independently at 2019 and 2023, and you forget what happened in the middle, big improvement, as we've shared. All right, now we're going to hit you with a variety of miscellaneous statistics, including, as Karl mentioned, we'll go through the the 2022 income analysis that came from the Census Bureau. I do recommend those reports. The Census Bureau, you'll see them cited here in a minute when we get to them. So we shared the Fed's forecast last month. The cool thing about this, if you're seeing it for the first time, is how much better the Fed thinks the economy is in August, or how much better they thought it was in August versus June. Like the June projection for GDP for this year was a 1% growth rate in the upper left corner there. Now it's 2.1. They are predicting a much better GDP growth rate. Unemployment not going up as much as they had thought it would. The inflation, though, being about the same. And then the interest rates being about the same as they had projected. So they're saying, wow, things are just better than we thought from a growth and unemployment perspective, and we're not changing the inflation piece very much. When you get into 2024, more of the same, only a very important point here. Look at the difference in the projection of interest rates. And this is what scared Wall Street, right? Because interest rates and asset prices move in different directions. So you've heard the idea, interest rates will stay higher for longer. That was the message of the Fed's last speech, and their view is what it's going to take to get inflation under control. They're not saying we need to increase the rates tremendously from where they are now. They're just saying we need to hold these higher rates for longer. And that's what scared Wall Street, although today stocks popped up. Can't argue day to day, but in theory, if interest rates are staying higher for longer, that should be a headwind to asset prices, whether it's bonds or stocks. And that's kind of what the message was from this. It was this little chunk here, that 4.6 and 5.1, the 3.9 and 3.4. That's what scared Wall Street. It was great news for Main Street. We'll take it. A 4.5 unemployment rate is a definite recession. Can't say definite, but it's highly unlikely you go from the 3.5 or 3.6 rate that we had to 3.8 now to 4.5 and not have a recession. Karl has mentioned before, your best measure of that is when job creation goes to zero or negative. It's probably when you've peaked and it goes negative for a while. But the unemployment rate going up this much most likely would be a recession. They're not saying that anymore. In fact, that is, let's see if I've got it in here. I had it in a different, is it on this one? No. They're analysts that work with the Fed, sort of the Fed analytics group, saying they were saying they don't think there's going to be a recession. And that was a welcome news. People had been nervous about it for a long time, and Republicans were getting a lot of mileage out of that we're on, imminent recession, blah, blah, blah. And no, it's not likely to happen. Even according to the Fed economists, this is not really a recessionary kind of forecast, if they're right. When you look at GDP growth rates, Biden has been at about 2.6% through the second quarter. We're sharing this slide here. Normally we do it when the new GDP numbers come out, but there was a significant revision in the GDP going back. And so Trump looks better than he did before, 2.8, but for his pre-pandemic period, overall, about 2%. And then Obama's second term at 2.3. These numbers do move around a bit if you start with a different quarter. Like I think Karl's right when we could pick what we did, which is the first quarter. If you go to like the fourth quarter, you'll get numbers for Biden and Trump pre-pandemic that are right about 2.8 each, almost the same. But this is the right way to do it. Good piece of news here. It is now unanimous. The six factors, the six measures that the NBER uses, it's the National Bureau of Economic Research. These are the six measures they use to call a recession start or economic peak. All of them are showing growth right now. That one teal line at the bottom had been negative. Everybody's positive now for 2023. So as long as those numbers are all kind of going up on that trend, you don't have a recession. You got a growing economy and everything's solid. All the indicators are solid. Arguably the most important are the two guys here together, the green and the red. Those are the employment numbers, the jobs and the employment level from the two surveys. Both of them are looking good. The chances of recession, as predicted by the Federal Reserve Bank of New York, they use a model that uses treasury spreads. I'm not going to get into it, nor do I fully understand it, but it has to do with the differences between the 10-year and the 3-month T-bill rate. They have been lowering their probability of recession. It had peaked in May at 71%. Kind of hard to see because the line sort of crammed over here against the border, but it's been coming down since May, peak about 71. Now it's at 56%. And that's the chances we'd be in a recession the next year. That number has been falling now for 4 or 5 months. So that's good. So this gets into now the Census Bureau data that we talked about a little bit last week, and we're going to peel that back a little bit on the income report. There's a separate report on poverty and another one on the uninsured. We'll hit the poverty briefly, and the uninsured is more or less a good news story through 2022, and we've got a slide on that. But we'll dig into this a little. So last month we talked about this a bit. This is real median household income. So this is a median means half of the households are above and half are below. So it's not distorted by an average. A rich person, as Karl loves to say, Bill Gates walks into a room and everybody's average income just jumped. Median doesn't do that. Median, the middle person in the room is the median. And so this number has come down from the peak in 2019. This is a Trump friendly statistic right now. It's one I would use if I were him. And it's come down from there about 2.5% versus 2021 and about 4.7 from 2019. The jump in the last year, or the drop in the last year, had a lot to do with a big increase in the number of households. Mathematically, it's not exactly right because we're using medians and not an average, but if you're down 2.3% in this per household number and your households increased by 1.5%, your income is down somewhere in the 0.8 range. And so about 2/3 of that decline is from the big jump in the number of households, which is a sign of prosperity. So I know that's a tortured explanation. You want to see this number always going up. But if you're going to have it go down, the denominator just jumping a lot is better than the numerator falling a lot. And that's what happened here, if I'm understanding that data correctly.
That's
so,
a reminder from last
not
month.
Not as bad a story.
As a reminder from last month, the downward trend in 2019 and 2020, Trump was president. So only that last downward segment is Biden.
Correct. All right. Now let's dig into this number a little bit. Let's break it out by different groups. And I know this is a little bit small, but let's explain what this is. So the dot is where the median income is. Further to the right means higher. So for example, the Asian in the middle, 108,700. That's the median income of an Asian family, the highest of any demographic, any racial demographic. We'll look at education all the way at the bottom. If you've got a bachelor's degree, your household, those households have a higher income than most. So working our way down, and you look at the right-hand side, these bars tell you whether it went up or down versus last year. So you can see like all the households were down 2.3 as we talked about. Women though, let's talk family first. Family households were down, but households run by women were actually up. Where did I get that? I might have just picked that statistic up from the text. I apologize, but the non-family households were up a little bit. So these are single households, but the women were up 4.3. So the women were driving it. That's this third line. White down, a white non-Hispanic down. So Black and Hispanic saw increases in their income, and Asian saw a slight drop. So different depends on the demographic group. And then down here, native born and foreign born, we talked a little bit about that. Native born down, foreign born up. Regions all down. Oh, nope. South went up slightly. No, it's still negative. Sorry, I'm looking at that blue line. Looks like it's up. It's down. Everybody's down regionally. And then I'm not sure how these MSAs work, to be honest. I haven't studied that. And then down here, education. Look at that. The no high school diploma, even though it's at the bottom of the heap, went up by 6.4%, a big jump in that income. So this is the Trump group, right? The non-high school diploma white male is the Trump epicenter. Good news under Biden. We should make sure the electorate knows that probably. High school, no college, and the others were all down. But still, having a bachelor's degree really pays. You can see almost double what everybody else makes if you're at some college, and even some college makes a really big difference. Here is the trend over time by demographic group. So Asians at the top, although they dropped slightly. Whites dropped, as we talked about. The all races this year, that's the overall number. And then the Hispanic up slightly, Black up slightly. Now, here's income inequality. And so they break this out by group. So this is the household income. And this shows share of aggregate income by percentile. So this these should add up to 100. I'm thinking correctly here. Maybe, is that right? Maybe they don't add up to 100. They may have some funky stuff in their average. No, I see what they're doing. The top 5% is sort of broken out again here. These are the quintiles. Those should add up to 100. And then the top 5% is split out of the highest quintile. But the folks at the bottom are seeing the bigger gains. Folks at the top, lesser gains. So that means an improvement in inequality, at least in the past year. The Gini index is a fancy way of measuring inequality, and the definition is here at the right. A Gini index of 0 means everybody gets the same. Top 1% gets 1% of the income. Wouldn't even be the top 1%. Every percent is the same amount. Nobody's at 0 in Gini. It's a theoretical construct out to a Gini score of 1, which would be a total inequality, meaning one guy's got all the money. And so we're in the middle, but the Gini number has fallen, which is an indicator of improving inequality. And I'm not sure of the distinction between the money income and the equivalence adjusted, but the trend is basically the same in kind of numbers. So that's good news. Inequality improving, but as Sonny was bringing up earlier, we got a long way to go on inequality. We're just getting started on that one. But again, the census report, it's written in reasonably plain English. It's not written for economists, and it's got some good charts and graphs in it, and it'll go into great detail. And then there's appendices with a ton of stuff. But if you search on census household income, this report will come right up. And I've got it cited down here at the bottom if you need help with the search. They do a separate report on poverty. We covered this briefly last time. The official poverty rate actually fell slightly this year. However, the number you heard about in the news is the third bullet. The supplemental poverty rate increased dramatically. And this rate it includes this, well, what happened is this temporary child tax credit and earned income tax credit expired. They were pandemic measures that extended them, not only gave more dollars, but also qualified more people for them, and then those went away. And that dramatically reduced the poverty rate measured by this method. And interestingly, even though it was the program was ended, it tells you that public policy makes a difference in poverty. It can dramatically reduce poverty. And I don't remember the number, but there were millions of people, children and families that went out of poverty because of that tax credit, and then it ended and nobody extended it, sadly. But the official poverty rate did get better. This was another statistic that's Trump friendly, where he had a very good year in 2019. It was lower than, I think that was the lowest in the records that they have going back to 1958. So good poverty year in 2019. Last one is the uninsured. They have a report on just the uninsured, and you can slice it and dice it any way you want. But the under 65 population, because over 65 is covered by Medicare in theory, under 65 was the lowest number in sort of the recent era of these statistics. I've got them going back into the late 90s on this, and this is the lowest percentage. It's in that 10% range, down from 17% in 2019. I mean, it's a significant improvement in the uninsured percent, not 17%. Sorry, it's down like 12% back then. It's down 17% in number terms, from 32.8 to 27.3 is a decline of 17%, 5 million. The percent of the population, that right-hand line, is about 10% now uninsured, and that had been more like 12 in 2019. But really good news story. Even in 2020 under Trump, you saw a reversal of some of his ACA sabotage that he'd been doing in 17, 18, and 19. In 2020, with the pandemic, the ACA was expanded, even though he was president. And you got the good trend started, and it kept going through 2022. This number is likely to jump because you've got people that are on Medicaid that are losing their coverage, something we've got to cover at some point. But the expiration of the pandemic has caused a lot of people that are still qualified to lose their coverage. They have to renew it. They have to take steps to do it, and people aren't really good at that. So I suspect when we get to 2023 data, it's going to be up. Inflation expectations, something the Fed watches closely and gets daily, so they can get real-time feedback. They've been raising their interest rate, as you know, it's averaging around 5.25 now. But the inflation expectations have been sort of moving sideways in this 2-3 range They would like those down a little bit lower, more like 2, or you can see down here getting back down into the 1.5 range, but they're not out of control. They're not going up. And so the Fed has to make a decision of, if this goes sideways, are they happy with that? Do they want to raise rates to try to move it? Keep in mind, if inflation is falling, let's say that rent inflation, which we think is falling, let's say it starts to fall more consistently. The fact that interest rates are up here, 5.3, and inflation is falling means that the real rate of interest is going up, right? That difference between this 5.3 and the rate of inflation, that is widening that gap. That means that the Fed is putting more brakes on the economy. When the bigger, the higher the real rate of interest, the more of a contractionary step the Fed is taking. And so even if the Fed does nothing, if inflation keeps falling, the real rate of interest is rising. And also the Fed is buying, let's see, are they buying or selling? The Fed is selling the assets that are currently on its balance sheet. So the Fed buys bonds and puts money into the system when it wants to boost the system, and now it's doing the opposite. It is selling bonds, taking cash out of the system, and as it lowers the size of its balance sheet, that is also contractionary. So even if the Fed does nothing, it's still contracting the economy. And that's something one of the Fed governors was talking about in a speech last week. He was saying, hey, we're still doing a lot, even though we're doing nothing. It's like, what? Kind of a head scratcher. Like, what are you talking about? But yeah, they are continuing to see the real rate of interest go up. They are continuing to see, and they're continuing to shrink their balance sheet. So their Fed is still doing stuff behind the scenes. One good piece of news, if you're a stock market person, one of the favorite COP talking points was, look at your 401k, it's getting killed, blah, blah, blah. I mean, yeah, the 401ks, the S&P 500 index peaked in early 2022, and it was down quite a bit for a while, and then it's come back up quite a ways as well. But when you average the Biden era and the Trump era, we're about 48% higher. So, if you were happy with your 401k where it was in 2019, you should be pretty happy where it is in 2023. It's 48% higher if you just own a pure S&P 500 index fund. Now, many people have bonds and other things in there, but it didn't jump like that. But if, a 401k is very heavily an S&P 500 thing for the younger cohorts, they're looking good right now. All right. I guess that one hasn't been updated. I don't have the box in. So here we are at the end. A couple slides and then we're done. When you compare 2019 on average, so you average those stats for the year, whether it's 4 quarters or 12 months, take the average, and you do the same thing for Biden for 2023, at least for the data that's available. 2023 looks way better. On about any measure you can think of, 2023 looks better, and this is adjusted for inflation, so you've got real. Whenever you see real, that means that you've got an adjustment for inflation in there. All the measures look better. And quite a bit better if you're looking at like the stock market, as I was pointing out, the uninsured is way lower, the net worth is up. All these numbers are looking good. And I think that is a message that is like a carefully guarded secret that we have in here, but try to share it in the world as much as you can, because 2023 looks great. And if you use 2022, it also looks pretty much the same on the statistics I've got here. If I were Trump designing this chart, I would make sure to get the poverty rate and the real household income in there to compare 2022 to 2019. You would see that things are a little worse on those two measures, but on these very important measures, the economy is looking better. And here are some links and things you can find to help with this. If you're looking at the presentation, you can click on these and they'll take you there. And a couple of these are due for an update. They're about a month out of date, some of them, but some of them are classics, like why are Republican presidents so bad for the economy? That's an article that never goes. It's been true for a long time and it's still true. So questions, I open it up for discussion. That's the end of our prepared remarks.